Investing in stocks can be a great way to build wealth over time, but getting started can feel overwhelming. Here's a step-by-step guide to help you get started on your investing journey, making it as easy as possible for you to begin building wealth. With that being said, let's dive right in. Number 1, understanding the basics. Before you dive into buying stocks, it's important to get a good grasp on what they actually are. Think of stocks as tiny pieces of a company. When you purchase a stock, you're essentially buying a small ownership stake in that company. Stocks represent ownership in a company. Imagine a company is like a big pizza. Each stock is a slice of that pizza. When you buy a stock, you're getting a slice of that company. For instance, if you decide to buy a share of Apple, you're buying a small portion of Apple Inc. It's like having a tiny piece of that company's success and profits. If Apple does well and makes a lot of money, your share can increase in value. Conversely, if Apple struggles, the value of your share might go down. Owning stocks gives you a few key benefits, such as ownership and voting rights. As a shareholder, you often get to vote on important company decisions, like who sits on the board of directors. This means you have a say, even if it's a small one, in how the company is run. Some companies pay dividends, which are a portion of the company's earnings distributed to shareholders. For example, if you own stocks in a company that pays dividends, you will receive regular payments from that company. This is like getting a little extra reward for owning a piece of that company. If the company does well and its stock price goes up, you can sell your share for a profit. This is known as capital gains. For instance, if you bought a share of Apple for $100 and later sold it for $150, you'd make $50 profit. Let's put this into a simple scenario. Suppose you buy one share of a company like Microsoft. You've now become a part owner of Microsoft, even though you might only own a very tiny fraction of it. As Microsoft earns money and grows, the value of your share can increase. If the company makes good decisions and generates profits, the stock price might go up, and you could benefit from selling your shares at a higher price than you bought them for. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. You need to know that investing in stocks also comes with risks. If Microsoft faces challenges or the stock market drops, the value of your share could go down. This means you could lose money if you sell your shares for less than what you paid. Let's say you're interested in buying stock in a popular company like Netflix. If you buy one share at $200, you now own a small part of Netflix. If Netflix grows and becomes more successful, your share might be worth more in the future. However, if Netflix has problems or its stock price drops, the value of your share could decrease. By owning stocks, you're participating in the company's financial journey. Your shares rise and fall with the company's fortunes, and your investment's value reflects the overall company's success. Understanding this concept of stock ownership can help you make more informed decisions when investing. You're not just buying a piece of paper, you're buying a small stake in a company and sharing in its financial outcomes. Number 2, set goals. Before you start investing in stocks, it's important to understand why you want to invest. Your reasons will shape how you approach investing and what strategies you use. For example, if your goal is to save for retirement, which could be decades away, you're likely to adopt a long-term investment strategy. This might involve taking on more risk with the potential for higher returns, knowing that you have time to recover from any downturns in the market. In contrast, if you're saving for a big purchase, like a house within the next 5 years, you might prefer a more cautious approach. You'd want your money to be relatively safe and accessible, so you might choose a more stable investment, such as bonds or high-yield savings accounts, to ensure your funds are available when you need them. Determining how much money to invest is the next crucial step. If you're new to investing or unsure about how much to commit, it's wise to start small. For instance, you might begin with $100 to $500 to get a feel for how investing works without risking too much. As you gain experience and confidence, you can gradually increase your investment. This gradual approach allows you to learn and adjust your strategy based on your experiences and the performance of your initial investments. Let's consider a practical example. Suppose you're saving for a down payment on a house that you plan to buy in 5 years. In this case, you might choose to invest in lower risk options to preserve your capital and ensure you have enough money when the time comes. You could start by investing $200 a month into a high-yield savings account or a low-risk bond fund. On the other hand, if you're investing for retirement and you have 30 years before you retire, you might take a more aggressive approach. You could invest $500 a month into a diversified portfolio of stocks and bonds, gradually increasing the amount as you become more comfortable and as your financial situation evolves. Number 3, open a brokerage account. To begin buying stocks, you first need to open a brokerage account. Think of this account as your gateway to the stock market. It's where you'll manage your investments. A brokerage account is held with a financial company that allows you to buy and sell stocks. There are many online brokers available, such as Charles Schwab, Fidelity, and Robinhood. Each one has its own set of features and fee structures, so it's a good idea to compare them to find the one that best suits your needs. For example, some brokers offer lower fees but fewer features, while others might provide a range of tools and educational resources that could help you as you start investing. Once you've set up your brokerage account, it's important to understand the different types of stocks you can buy. Stocks generally fall into 2 main categories: common stocks and preferred stocks. Common stocks are the most typical type you'll encounter. When you buy common stock, you gain voting rights in company matters, such as electing the board of directors. Additionally, you might receive dividends, which are periodic payments made to shareholders from the company's earnings. However, there's no guarantee that you will receive these dividends, as it depends on the company's performance and decisions. For instance, if you buy common stock in the company like Tesla, you'll have the opportunity to vote on important company decisions and might receive dividends if Tesla chooses to distribute them. However, if Tesla doesn't pay dividends, you won't receive any income from your investment other than potential increase in the stock's price. Preferred stocks, on the other hand, often provide fixed dividends and have a higher claim on assets than common stocks if the company goes bankrupt. This means that if the company is liquidated, preferred shareholders are paid before common shareholders. Therefore, preferred stocks usually don't come with voting rights. This type of stock can be appealing if you're looking for a more predictable income stream from dividends, but it comes with trade-offs, like not having a say in the company decisions. Number 4, research and diversify. Before you buy any stock, it's crucial to do your homework on the company. Think of this as a way to make sure you're making a smart investment. Start by examining the company's fundamentals. This means looking at its financial health to see if it's a solid investment. Check the company's revenue, which tells you how much money it's bringing in from its business activities. Look at its profit to understand if it's making more money than it spends. Also, consider its debt levels to ensure the company isn't overburdened by borrowing. Next, look at the stock's performance over time. This involves checking how the stock price has moved in the past. If a stock has consistently risen in value, it might indicate a strong company, but it's also important to understand why it's been performing well. Conversely, if the stock has been volatile or declining, you'll want to dig deeper into the reasons behind this trend. Another key area to research is the industry in which the company operates. Understanding the industry helps you gauge the company's growth potential. For example, if you're interested in investing in a tech company, research its latest innovations and see how it stacks up against its competitors. Look at industry trends to determine if the sector is expected to grow or face challenges. This information will help you assess whether the company is likely to thrive or struggle in the future. Diversification is also an important strategy when investing. This means spreading your investments across different stocks and different types of assets. Don't put all your money in a single stock or sector. For example, if you invest solely in technology stocks, a downturn in the tech industry could significantly impact your investments. Instead, consider diversifying your portfolio by including stocks from different sectors, such as technology and healthcare. This way, if one sector experiences a decline, the stability in another sector might help balance out your overall investment performance. Number 5, decide how many shares to buy. Based on your research and budget, decide how many shares of stock you want to buy. For example, if a stock costs $50 per share and you have $500 to invest, you could only buy 10 shares. Remember, you can also buy partial shares with some brokers. Once you've bought stocks, Keep an eye on your investments, track their performance and stay updated on news related to the companies you're invested in. However, don't panic if the stock price drops temporarily. Long-term trends are more important. Investing is often about patience. Stocks can fluctuate in the short term, but over time, they generally grow in value. Stay informed about market trends and company news, but avoid making hasty decisions based on short-term market movements. Imagine you've decided to invest $1,000 in stocks. You could allocate $200 to a tech company you believe in, $300 to a well-known consumer goods company, and the remaining $500 to a diversified index fund, which spreads your investments across many companies. This approach helps balance potential high returns from tech with stability from consumer goods and broad market exposure from the index fund. By following these steps, you can start investing in stocks with confidence. Remember, investing is a journey, and the more you learn and experience, the more adept you'll become at managing your investments. Which stock companies piques your interest? Share your thoughts below, and don't forget to like and subscribe for more valuable content.